What is an arbitrage opportunity? This is the question that we will be answering in this video. We'll be talking about different types of arbitrage as well. And this video is part of our course on fundamentals of trading. Let's begin with our outline today. So we will first explain what an arbitrage opportunity is. Next, we will talk about pure arbitrage, given some practical examples. After that, we will talk about statistical arbitrage. And finally, we will be discussing risk arbitrage. There are thumbnails in the video description, so if you would like to jump ahead to a particular part, feel free to do so. Let's get started with our basic definition. What is an arbitrage opportunity? Well, first of all, arbitrage opportunities arise in the event of a mispricing. So at least one asset or more assets need to be mispriced for an arbitrage opportunity to arise. And in such a case, what traders would try to do is essentially to implement a strategy of trying to buy low and sell high. As I mentioned earlier, there are different types of arbitrage. Next, we'll be talking about pure arbitrage, which involves no risk at all. But other types of arbitrage, such as statistical arbitrage and risk arbitrage, both involve risk. So they are not actually pure arbitrage strategies. And we will explain all of them in order. And one final thing to mention is that arbitrage opportunities are usually temporary windows of opportunities, especially when we talk about pure arbitrage. So this means that in competitive markets, arbitrage opportunities are not meant to last long. As arbitrageurs seize these opportunities, their trades are self-destructing in the sense that they help correct the prices, right? And the actions of the arbitrageurs actually contribute to the pricing efficiency of those markets. Okay, let's move on to our first type of arbitrage, which is pure arbitrage. And I'll motivate this with an example from bond markets. For pure arbitrage to exist, we need to satisfy three conditions. First of all, the strategy should have no risk. Okay, so it should involve no risk. It should generate positive profits, right? It should never result in a loss, right? So there will be different, of course, states of the market, right? In different states, the profit might vary, but it's always expected to be non-negative for the opportunity to be defined as pure arbitrage. And also, the opportunity needs to be self-financing. What we mean by that is that it shouldn't require any capital from the arbitrageur. And this is established by generating both long and short positions such that the short position finances the long position. So let me explain this through an example from bond markets. We've got a coupon bond here, which makes annual coupon payments. Typically, bonds might make semi-annual payments, but for simplicity, we are assuming annual coupons here, right? So it's going to pay $200 next year, another $200 plus the face value in 2 years. So the bond is essentially maturing in 2 years' time. And the current price is $1,100. And apart from this coupon bond, we have two zero bonds. Zero coupon bonds always trade less than their face value. They are set to trade at a discount. So if you look at the 01, the face value is 1,000 and it's going to be paid next year. And the bond is today trading at $900. And the second zero coupon bond is trading at $825 today, and it's maturing in 2 years' time, and at that point it's going to pay its face value. Now, you might notice that I can actually create a portfolio of 01 and 02 to exactly match the cash flows of the coupon bond. So let's try to do that. So if you look at the first cash flow of the coupon bond is 200, right? I've got 01 maturing exactly at that point in time, but it is offering me $1,000. Okay, so if I actually purchased 0.2 units of 0.1, so 0.2 units, right? 0.2 times 0.1, it would give me $200, which exactly matches the cash flow of the coupon bond. How about cash flow 2? In 2 years' time, the coupon bond will be paying 1,200. And now I need to look at 0.2, which is given 1,000 at that point, so it's not matching the cash flow of the coupon bond. But if I purchased 1.2 units of 0.2, then the cash flows would match, right? So if you think about it, a portfolio that invests in 0.2 units of 0.1 and 1.2 units of 0.2 has identical cash flows with the coupon bond, right? The law of one price says that assets that have identical cash flows should trade at the same price. So, which means that the coupon bond price is 1,100. Okay, so this should be equal to 0.2 times the price of the first zero, which is 900. Okay, plus 1.2 times the price of 825, right? So let me do the calculations here. I'm just going to pause. Right, I paused the video for 1 sec there to make the calculation. So the right-hand side of this equation is actually 1,170, which is of course not equal to 1,100, right? This is not equal to one another. So there we go. So we've got a mispricing here, right? So we have two identical assets, the coupon bond and the portfolio of the two zero coupon bonds, right? And although they have the identical cash flows, their prices are not matching. So how am I going to exploit that? So the coupon bond is relatively cheap. So I would go long in the coupon bond and short in the portfolio, which is more expensive, right? Because I'm trying to buy low and sell high, right? So I'm going to short sell the portfolio and use the proceeds generated from there to invest in the coupon bond. This strategy has no risk because the cash flows are identical. It will yield me a positive profit, and I have used no capital on my own, so it is completely self-financing because of the combination of long and short positions. So this is what we mean by pure arbitrage. Pure arbitrage opportunities are not easy to come by in competitive markets, and when they do, they are quickly exploited, right? And they are self-destructive, right? So you need to trade in large volumes and quickly to be able to earn any profits, and institutional investors can generally do that in stock markets, but it's hard for retail investors to achieve that, right? Because the correction occurs quite quickly. All right, so this was our first type of arbitrage opportunity. Now let's move on to the next type, which is statistical arbitrage. This is an interesting concept. Again, this is commonly used by investment banks and hedge funds, mainly because it's a computationally intensive method and it's a highly quantitative approach as well. It has its roots in what's called pairs trading, which is the last bullet point here. So the idea of pairs trading is that you find two stocks that are highly correlated, Coca-Cola and Pepsi, and you would essentially go long in one of the two and short in the other when they are sort of diverging in value, because you know that if the prices sort of start to separate from each other, at some point they will come back, right? Because they are highly correlated and you expect that their prices have to follow closely with each other. So there relies the ideas of mean reversion and co-integration. So the whole idea of statistical arbitrage is to build large portfolios containing such correlated stocks and rely on mean reversion and co-integration. And these large portfolios are actually invested typically for short durations to exploit those mispricings, right? And eventually the position can be liquidated or updated. But notice that this is not completely risk-free like pure arbitrage. Because here, first of all, this relies on your model, right? So if your model is inadequate, you might get it all wrong, in which case you might suffer large losses. And second of all, even if your model is right, you don't know about the horizon in which the strategy will pay off. So there is uncertainty there as well. Okay. And the final part of the video talks about risk arbitrage. Now, risk arbitrage is also known as merger arbitrage. It can the logic of risk arbitrage can apply in different settings, like in company liquidations, etc. as well, but most typically is applied in the M&A context. And I would like to motivate it with a real-world example from early 2000s. I believe it was in 2001 when Hewlett-Packard, HP, the computer manufacturer, announced its bid to purchase another computer company, Compaq. And when they made the offer, they valued Compaq at a premium of 19%. This is quite typical in takeovers. The acquirer firms usually need to offer the target firm a premium. So this means that if your shares are worth 100, they say that I'm going to buy that at 119, giving you a 19% premium. And the logic is that the acquirer believes that the merger will generate synergies, so the combined business will be more valuable than the sum of its parts. So essentially, they are sharing that generated value with the target shareholders by giving them a premium. But what often happens is that following the announcement, yes, the target share price will increase, right? Because they are suddenly valued at a premium of 19% by a particular party. But typically the share price may not rise as much as 19%. And this creates what's called a merger arbitrage spread, right? And in the case of HP Compaq, after the announcement, Compaq shares were trading about $1 cheaper, initially $1 cheaper, relative to what was implied by this premium. Now, traders or investors can exploit this discrepancy. And the strategy here is that because Compaq shares are relatively cheap, you would go long in Compaq and short in HP. But the key point here is that, again, this is a risky strategy because it relies on the completion of the deal. In fact, merger arbitrage spread after the announcement is made is not static. It varies over time with the probability of completion. So the spread declines, so it goes down, it gets tighter if the probability of completion increases, and it gets wider if the probability of completion decreases. Then it's up to investors to judge whether the deal will be completed or not based on the available information. In fact, what happened in this particular merger was that there was big oppositions to the deal. So a son of the co-founder of the company and a board member, I think it's James Hewlett, opposed the deal. And when he actually announced his opposition, the merger arbitrage spread increased a lot. It got a lot wider because people started fearing that the deal wouldn't be completed. And if it happened indeed that the deal sort of broke through at that point, the arbitrageurs would make substantial losses. But eventually, luckily for them, the deal was completed. So for the arbitrageurs who actually bet on this deal, the deal paid off. But as you can see, this is not pure arbitrage because of the fact that risk is involved. All right, that's all I wanted to cover in this video about arbitrage opportunities. I hope you have found it useful. As usual, if you liked the video, please hit the like button. If you subscribe to our channel, we would appreciate it as well. and I'll be looking forward to seeing you in another video.